Dividend investing is an increasingly popular strategy for individuals seeking to build long-term wealth. It offers a unique opportunity to generate a stream of income from investments, even while you're not actively working. This type of investing is particularly attractive to those who want to earn passive income, allowing their money to work for them rather than the other way around. Today, we will explore how dividend investing works, why it's a great strategy for beginners, and how you can use it to earn money while you sleep. Dividend investing refers to the practice of buying stocks or other securities that regularly pay dividends. A dividend is a portion of a company's profits that is paid out to its shareholders. Dividends can be issued quarterly, semi-annually, or annually, and the amount is usually determined by the company's board of directors. While not every stock offers dividends, many well-established financially stable companies distribute a portion of their earnings to shareholders as a way to reward them for their investment and encourage long-term ownership. One of the most attractive aspects of dividend investing is the potential for a steady, predictable income. Unlike other investment strategies that might rely on capital appreciation, such as growth investing, dividend investing offers cash payouts that can be reinvested or used as regular income. For those who are just starting to invest, it offers a low-risk way to enter the market and begin earning passive income right away. Let's break this down in more detail. First, let's talk about how dividends work. Companies that issue dividends usually do so from their profits. If a company is generating strong earnings and has a history of stable or growing profits, it's more likely to pay dividends to its shareholders. Some companies, particularly in sectors like utilities, consumer staples, and real estate, are known for paying consistent dividends. These companies tend to be well-established, less volatile, and more predictable in terms of performance. The amount of the dividend is usually expressed as a dollar amount per share or as a percentage of the stock price, called the dividend yield. For example, if a company pays an annual dividend of $2 per share and the stock price is $40, the dividend yield, this yield gives you an idea of how much income you can expect relative to the price of the stock. In some cases, the dividend yield can provide a significant portion of your total return on investment. Now let's talk about why dividend investing can be especially appealing for beginners. First and foremost, it provides a sense of stability. For new investors who may be unfamiliar with the volatility of the stock market, dividend-paying stocks can offer a safer entry point. Since dividends tend to be paid by established companies with a track record of profitability, they are generally less risky than investing in newer, more speculative companies that may not offer dividends. Moreover, dividends can serve as a cushion during market downturns. When the stock market is experiencing volatility, the value of your stocks may fluctuate, but the dividend payouts remain steady as long as the company continues to generate profits. Even if the stock price drops temporarily, you can still receive a reliable income from the dividends. Over time, this income can add up, especially if you reinvest those dividends by purchasing more shares. Reinvesting dividends is one of the most powerful strategies in dividend investing. Many investors choose to reinvest their dividend payouts instead of taking them as cash. This strategy, known as dividend reinvestment, can significantly enhance the growth of your portfolio over time due to the compounding effect. As you reinvest your dividends, you are purchasing more shares, which in turn generate more dividends, which you then reinvest, and so on. This compounding process can result in exponential growth, making your investment more valuable in the long run. Another key benefit of dividend investing is the potential for income diversification. While many investors focus on building wealth through capital gains, dividend investing allows you to tap into a steady stream of income, even in a flat or down market. By diversifying your investments across different dividend-paying stocks, you can reduce the risk of losing your income if one of your investments doesn't perform as expected. Additionally, dividend-paying stocks often belong to different sectors of the economy, further diversifying your risk. Now, you might be wondering, how do you choose the right dividend stocks to invest in? There are a few important factors to consider when selecting dividend-paying stocks for your portfolio. First, look for companies with a strong history of paying dividends. Ideally, you want to invest in companies that have been consistently paying and even increasing their dividends over the years. This shows that the company is financially stable and has a track record of rewarding its shareholders. Next, check the dividend yield. While a high dividend yield may seem attractive, it's important to ensure that the company is able to maintain the payout. A very high yield could be a red flag, as it might indicate that the company is struggling financially or that the stock price has dropped significantly, which could affect the sustainability of the dividend. A more modest yield, combined with steady growth, is often a safer and more reliable option. Another key factor is the dividend payout ratio. This ratio tells you what percentage of a company's earnings is being paid out as dividends. A high payout ratio might indicate that the company is not reinvesting enough of its profits back into the business, which could limit its future growth potential. Conversely, a low payout ratio may suggest that the company is not paying out enough to its shareholders, or it might be retaining earnings for growth. Look for a balance. Companies with a payout ratio between 40% and 60% are often in a healthy financial position. When you're just starting out, it can also be helpful to invest in dividend-focused exchange-traded funds, ETFs, or mutual funds. These funds pool together investments in a wide variety of dividend-paying stocks, providing instant diversification. Many of these funds also have low expense ratios, making them a cost-effective way to build a dividend investing portfolio. By investing in an ETF or mutual fund, you don't have to worry about selecting individual stocks or monitoring their performance as closely. The fund manager does that for you. As you build your dividend investing portfolio, keep in mind that it's important to be patient. Dividend investing is a long-term strategy that requires time to realize its full potential. The key to success is consistency, both in terms of reinvesting your dividends and in holding on to your investments over time. While you may not see significant gains in the short term, over the course of several years, the combination of dividend payouts and compounding growth can lead to impressive results. One of the most exciting aspects of dividend investing is the ability to earn income passively. Once you've built your portfolio and set up your dividend reinvestment strategy, the income from your dividends can continue to flow in without much effort on your part. This is often referred to as earning while you sleep, because the dividends continue to come in whether you're working or not. Over time, as you accumulate more shares and reinvest your dividends, this passive income stream can become a significant source of wealth. For those who are approaching retirement or seeking to supplement their income, dividend investing can be an especially powerful tool. The dividends you receive can help cover living expenses, and you don't need to sell your investments to generate cash. This can be particularly beneficial if you want to avoid selling assets in a down market, as you can rely on the dividend income to sustain your lifestyle. However, it's important to remember that no investment strategy is without risk. Dividend stocks can still lose value, and companies may reduce or eliminate their dividends in tough economic times. That's why diversification is so important. By spreading your investments across different sectors and industries, you reduce the likelihood that a single downturn will severely impact your income stream. In conclusion, dividend investing is a powerful strategy for beginners who want to earn passive income, build long-term wealth, and generate cash flow without having to actively manage their investments. By focusing on financially stable companies with a strong history of paying dividends, reinvesting those dividends, and diversifying your investments, you can create a steady stream of income that continues to grow over time. As you develop your portfolio and practice patience, you'll be able to enjoy the benefits of earning money while you sleep. Dividend investing is an excellent way to generate a consistent and reliable source of passive income, making it particularly attractive for individuals seeking to earn money without having to actively manage their investments. When you invest in dividend-paying stocks, you receive regular payouts from the company's profits. These dividends are typically paid on a quarterly, semi-annual, or annual basis, providing you with predictable income at regular intervals. For investors looking to supplement their income, this steady stream of cash can be highly beneficial. The real power of dividend investing lies in the fact that you can earn income without having to sell any of your holdings. This means that even if the market is experiencing fluctuations or downturns, your income remains unaffected as long as the company continues to pay its dividend. This makes dividend-paying stocks a relatively stable and lower-risk investment, particularly for those who are just starting out or looking for safer alternatives to high-growth, more volatile investments. Additionally, the income you receive from dividends can be reinvested into purchasing more shares of the company or other dividend-paying stocks. This process of reinvesting your dividends, also known as dividend reinvestment, allows your money to continue working for you, amplifying the growth of your portfolio over time. As you accumulate more shares, the dividends you receive grow as well. creating a compounding effect that can significantly increase the value of your investments. In summary, dividend investing offers a way to earn passive income that is both predictable and sustainable without the need to sell your assets. Whether you use the income to cover living expenses or reinvest it for future growth, dividend-paying stocks are a powerful tool for creating long-term wealth. One of the most compelling reasons to pursue dividend investing is its ability to build long-term wealth through the power of compounding. Compounding occurs when the returns on an investment generate their own earnings, which in turn generate more earnings. In the case of dividend investing, this process is amplified when dividends are reinvested back into purchasing more shares of stock. Over time, as the number of shares you own increases, so too does the amount of dividends you receive, creating a snowball effect that accelerates wealth accumulation. When you reinvest dividends rather than cashing them out, your money is working for you continuously. Each time a dividend payment is made, you use that cash to buy more shares of the stock, increasing your position in the company. As a result, you start receiving even higher dividend payouts in the next cycle. This reinvestment strategy allows you to benefit from compounding, where not just your original investment, but also the dividends you've already received grow and generate additional returns. For long-term investors, the power of compounding can be transformative. The earlier you start reinvesting dividends, the more pronounced the effect of compounding becomes. Small, consistent reinvestments made early in your investment journey can lead to substantial growth over decades. This is why dividend investing is often seen as a wealth-building strategy for those with a long-term horizon, such as people saving for retirement or those looking to accumulate wealth gradually. Even though the growth might seem slow at first, the compounding effect grows exponentially over time. As your dividend payments continue to reinvest and accumulate, the potential for wealth generation becomes significant. Over several years or decades, this strategy can lead to substantial returns, far outpacing traditional savings accounts or non-dividend stocks. In essence, dividend investing, with its focus on compounding, is a strategy designed to steadily build wealth over time with minimal effort. For beginners entering the world of investing, one of the key challenges is managing risk while trying to achieve positive returns. Dividend-paying stocks offer a relatively lower risk entry point into the market, making them an appealing option for those who are just starting out. Many of the companies that pay regular dividends are well-established, financially stable, and have a track record of consistent earnings. These companies tend to be larger, mature businesses in sectors like utilities, consumer staples, and healthcare, which are generally less susceptible to market volatility than newer or smaller, high-growth companies. Because dividend-paying stocks come from companies with solid financials, they are typically less volatile and more predictable in terms of performance. These companies have established business models and a history of generating steady profits, making them less likely to experience the sharp price swings associated with riskier stocks. This stability is crucial for new investors who may not yet be comfortable navigating the ups and downs of the stock market. The relative predictability of dividend stocks helps reduce the emotional stress of short-term market fluctuations, which can be particularly overwhelming for beginners. In addition to stability, dividends offer a cushion during market downturns. While stock prices may decline in the short term due to economic uncertainty or other factors, the dividend payouts often remain steady, provided the company's earnings continue to support the dividend. This consistency in income can help maintain financial security during market dips, offering a level of peace of mind that might not be present with more speculative investments. As a result, even when stock prices fluctuate, investors can still rely on their dividends as a source of income, reducing the impact of market downturns on their overall financial well-being. For new investors seeking a safer way to grow their wealth, dividend stocks offer a balanced approach with lower risk and reliable income.